Well, this is the best show that Larry and I do all month, maybe even the best show that we do on this channel every month, because we have a genius that we use as our fodder, as our content, Cathy Wood, who Larry and I are both very fond of, as Larry knows her personally now. And so he can even call her a friend. Larry, what did you think this month of Cathy Wood's analysis of the economy, both now and going forward? Is she hitting it out of the park again? How did she do?
I think we're at a point of discovery, whether Cathy has been right all this time or wrong.
Okay.
Because we're at the very point at which she says recovery is beginning from this long, arduous, rolling recession that she's described to us each month in great detail and with a great deal of evidence. Now is the testing moment. As you'll see, she's really put, a stake in the ground, and she said, guys, we've had a rolling recession all the way along, and now is the time we're about to launch this new economy. I am a little less as convicted as she is on the subject. I'm skeptical. I'd love her to be right, but I think we have some really rough time to get through before we get to the other side of this. What about you?
So I thought that she made a very good case for the rolling recession. Again, it's something I talk about all the time. We talk about all the time on the show. 4 different elements of the economy that did not participate at all. In fact, we're in recession, clearly in recession for the last 3 years. And also the dichotomy between those over 100,000 and those under 100,000 in income, huge dichotomy in terms of one being in recession under 100,000 and the over 100,000 crowd doing quite well, especially those who own assets. So I think she makes this case extremely well. I think that, Larry, you and I had come to these conclusions even outside of Cathy, but I don't think that many in the economic world still get it. I think there's a whole bunch of people that do not see that this rolling recession took place. But the question now is, how do we get out of it? You're a little skeptical about the timing. Last night, if people didn't see the show that you and I did last night, they may want to go back and look at it, because I believe that the enterprise part, you had a good word for it a minute ago, the existing companies and new companies that are coming into business at this point need to find a way to make money in this new paradigm, a worldwide paradigm and US paradigm. Big shift, huge shift. And that smart entrepreneurs will be sitting there going, okay, not only how do we defend ourselves in the situations where we have difficulties, but also how do we take advantage of the opportunities that are going to be in this new paradigm? And I think that those things are already underway. People are being hired, systems are being purchased, and that's going to impact the economy in the near term in a positive way. That's kind of the one thing I'm not hearing from anybody but me, and I'm probably completely wrong.
Your thesis is that the crisis precipitated by the administration by imposing these worldwide tariffs, absolutely random worldwide tariffs, is going to lead to a huge amount of entrepreneurship with new startups being conjured up in a whole range of areas. I think there's a lot to be said. For example, I've started a small separate set of investments. I've started its own little I guess investment. My family fund, my family office is opening this fund. It's going to be investing in US-based infrastructure companies.
Yeah.
And I've identified quite a few existing companies that have a strong record on building infrastructure.
Yeah.
Factories, systems,
Automation.
automation. And I've kind of tried to cover the ground with not just factories, conventional factories, but also healthcare type investments. And some of these are looks like very passe, very blasé kind of investments, so-and-so construction company. Well, it's not really a construction company, but it's an infrastructure company. So I'm focusing on those companies who are going to be in very significant demand as entrepreneurs need new factories thrown up very rapidly, new production lines thrown up very quickly. So so our friend Jeff, would be an ideal kind of agent for that kind of investment approach, and a lot of advice is available, on X in this area, but that's become a sort of focus of mine. So this portfolio, it's not really a fund, it's a separate portfolio at this point. I'm not taking outside money, of course. And so I'm going to build up this portfolio because I really believe, somewhat as you do, but on a slightly different scale of time and effort and investment, possibly, that this is an opportunity for us all. However, unlike you, and perhaps unlike Cathy, I think this kind of thing takes time. I think it's a 3 to 5 year process, and I think we're going to go through an extreme amount of pain between then and now.
So the last thing I'll say before we start the slideshow, talking about what Cathy actually said, is that one thing that Cathy does not say, and one thing that is being said by some economists as a result of last 2 weeks of information, earnings are still strong.
Yes.
The analysis, the expectations for earnings in the future were still strong. I think it was 85% of the companies beat earnings on the S&P. I think it was 85 or 86% beat earnings so far. And consumers are still spending, and companies are spending on R&D, not R&D, on CapEx, 22% up in that GDP report the other day. So we're seeing the CapEx already. We're seeing consumers still spending. They still have money in their jeans, and the under 100,000 group is actually getting real wages. Their
real wage increases.
Their real wage increases because inflation is at zero. So my theory right now is that will carry us for the next 2 quarters.
All good signs, but major retailers, their shelves will be empty by Christmas.
Okay, so I said I would stop, Larry, but I have to go on. I keep asking the question. I put this up. Everybody that says that, I'm practically trying to answer them on X, is like, please tell me what the items are that are going to be missing. It's only 14% of our 14% of our GDP is imports. I'm trying to figure out what's going to be missing.
Most of it's sold in December.
Right. So you have a lot of cheap plastic stuff. You've got a lot of toys. You got a lot of dolls and things of this nature.
Huge amount of components for vehicles. Huge amount of components for aircraft. Huge amount of don't underestimate the $30 thingamajig that keeps a Boeing 747 Boeing 787 from being delivered.
I'm surprised you didn't say 707, Larry. Okay, one last question, and then we really will get into the slides. Do you believe, as they did on the All In podcast last night, do you believe that in fact that all of these major issues, anything that's significant in the supply line, will be resolved within probably the next 60 days, to the point where ships will start being loaded in China again? There will be changes. Vietnam will have more business, Cambodia will have more business, and China will have less business, but that pretty much all of this will be behind us before it turns into really significant issues in terms of supply.
I mean, I can't tell the future because it's in
the future.
Very unpredictable set of players. I thought I was predicting the future quite comfortably when Gary Black was calling a disaster, and I was saying, no, this is the right thing to do. This is not smoot-hawley. This is like target. This is going to be very intelligently handled. Well, it's not, in my judgment. And I could be wrong. I'm as fallible as anybody. So I think that the administration made a lot more work for itself. That's what I think. And they could get past it. They can still achieve, a breakthrough or breakthroughs. They now have to achieve 250 breakthroughs or something. But they could achieve a breakthrough. But the job got tougher.
Okay. All right. With that said, let's go to the slideshow.
So let's let me share my slides here, and screen one, share. Tell me when you see it, if you see it.
There it is, introduction and context.
Yeah, so this is Cathy's Employment Friday presentation that we steal and throw up and then regurgitate, but with our own color on it, and we critique it or we praise it, but we also offer our own thoughts. So I hope Cathy's going to forgive us. So this Employment Friday presentation, I make these bullet points in early May 2024, reviewing economic conditions. I will also tell you this is the first time Grok has prepared this deck for me.
I see. Okay.
And I will also add that it didn't do everything I wanted it to do. It didn't even do like 50% of what I needed it to do, because Grok is not yet agentic. Now, I know Manus may have been able to achieve it for me. The problem with Manus, it would have run out of memory halfway there, and they would have left me with a mess to finish. So I would have had to cut the project. Anyway, bottom line is Grok is not yet agentic. I'm looking forward to the day that it can do all of the above. So ARK released a letter discussing the rolling recession, which is incorporated into the presentation. So I encourage everybody to go to the ARK website and look for the letter that Cathy published just a few days ago, because a lot of these slides come from that, and she discusses it in depth in the letter. I also encourage everybody to go and listen to Cathy in her own words. She's very compelling. It's very easy listening, and she does explain this in very great detail. You're probably going to get it. You're probably going to find that we two old farts going to mess it up very badly. But
well, we do take what she does in 45 minutes and turn it into an hour. So
an hour or two. And she's saying that the employment report appears stable, consistent with the last 3 years. She says labor hoarding post-COVID continues as companies retain workers until margins erode.
That was an important fact. I thought that was an interesting one that nobody's talking about. They're holding on to their people. We're seeing nobody doing big layoffs. We're not even seeing layoffs increasing in the weekly numbers. And I really hadn't thought it through like she just did.
Well, one thing I will tell you is that about a year ago, Elon laid off a lot of people. About a year or two ago, he laid off a lot of people, and that gave
Permission.
Silicon Valley permission to lay off people. And there was a big Silicon Valley layoff. But those people have been largely absorbed back into the AI world. Not necessarily the same people, but there's been a very significant hiring of IT folks and data folks. Well, they're IT folks, I guess. And so, technologists haven't had any problem finding jobs. Deflation may increase margin erosion, prompting a shift to capital over labor. And that's really my play. That's what I talked about starting this new portfolio.
Right.
I'm looking at that type of play. Researching automation and AI for the future economic impact. So I have no problems with that. I couldn't agree with that more. I'm 100% on board with everything everybody's saying about AI and then some.
Mm-hmm.
So, we cover fiscal policy, monetary policy, economic indicators, and market indicators, just as Cathy does. That's the section she raises. In today's discussion, we align with Cathy's letters focusing on the rolling recession. Very important letter because it really sums up what she's been saying for the last 6 months to a year or even more, maybe
Longer.
2 years.
Yeah.
And she addresses automation concerns because people say that robotics, automation, and AI are going to cause job loss, causing short-term displacement. Historically, she says technology creates more jobs over time. For example, farm automation led to net job growth. This time may be somewhat different.
It might be, but again, I encourage people to also watch the All In podcast last night. They were specifically looking at situations that they're already seeing in AI, where the AI is actually creating
new jobs,
new opportunities for the companies that require more people.
Look, there is going to be a replacement, but there's going to be a huge it's not going to be continuous. It's going to be discontinuous. So there's going to be some pretty significant changes.
I have a new analogy, not analogy, it's not the right word. I have a new picture that I give people about how the future may have way more jobs because of new opportunities. And maybe you've heard me say this before, Larry, and that is litter control. So we can't control the litter in the United States, the litter in the United States, apparently. It's still everywhere. But once we have robots, we will control the litter. It's something that's impossible under our current system, but will be possible in the future system. And then it will require humans to manage the robots that are out there doing. So there's all kinds of things like that we just have no idea.
Why would the robots not manage the robots?
Well, I think that the robots are not maybe going to be the best managers. We'll see.
So economic weakness and political pressure. So Q1 GDP negative, first since Q1 2022, increasing political urgency. I would not be surprised to see a Q2 negative as well.
But we do have to qualify Q1 as not being negative, Larry. It really was a technical negative. In fact, Cathy Wood said in her letter that it was almost 4% gain over the previous quarter. So if you take out the technical aspect.
Well, I think that Q2 is going to be a real negative.
Okay.
Midterm elections loom. Economic weakness threatens incumbent party. Republicans aim to pass tax package swiftly to counter economic slowdown. I cannot sufficiently stress the importance of the Republicans getting off the dime and getting the budget done and a tax reduction implemented.
Me too. 100% agree.
So Cathy's thesis is the rolling recession is ongoing with Q1 real GDP negative, Q2 may worsen. Companies report spending paralysis due to tariff and budget uncertainty. High-end consumers and government previously resilient now faltering. By the way, local governments increase their employment rolls by a very large percentage of the number of employment that federal government reduced it by. Very distressing.
Very distressing.
Very distressing. First government recession, downsizing of departments in 30 years since the Clinton-Gingrich era. So Clinton and Gingrich got together and both agreed to downsize the government. Not since then have we reduced the size of the government. And it's not only the government has grown in size, and this is a rant for a different day.
Right.
They've grown in their reach of power and their overreach, I should say. Anyway, that's a.
And let's just a second. Let's drop back to that third one.
Sure.
In terms of the over 100,000 group cutting back on spending for the first time. I don't think this will continue, at least if the S&P continues to, or the indices continue to go back into their all-time highs again, which there's every evidence that that's the directionality right now. So if we continue to see the stock market recover, I think the people that have wealth will go back out, start spending again.
I mean, it's possible. It's possible. I mean, I'm always the voice of doubt. You're always the voice of optimism. I'm not pessimistic.
You're realistic, Larry.
I would hope so.
Yeah.
I would hope so. The management of my previous company had doubts about my policies, but how real they were. But yeah, it's interesting. They're doing very well right now.
Yeah.
It's a recession, but for some companies, there's no recession at all.
Yeah.
So you need to describe the LER curve, and I'll hand it to you to describe. I'll rescue if you run into any difficulty.
Oh, I see. Okay. Well, I'm a big fan of the LER curve, always have been, going back to when this was happening in the Reagan administration. So if you reduce taxes on the folks, or you reduce taxes on business, then revenues go up. And there's a couple of reasons for that. One is if you leave more money in the hands of the folks that can be productive, whether that's companies or individuals, if you leave more money in their hands, they're better at spending it than the government is. And so as a result, they spend it. And to the extent that they spend it, it grows the economy. And as a result of the economy growing, it increases the amount of taxes that are coming into the coffers. The other aspect of the LER curve is that we've determined that, at least in America, there's a certain amount, a total amount of taxes where people shut down. So you could call it like a technical analysis that you do of the stock market, where, we're not going to be able to get over 300, right now on Tesla, because there's a psychological barrier. Well, apparently Americans have a psychological barrier when we get above about 18% of GDP, or when taxes get over a certain dollar amount or percentage amount of your income or the corporate income. And what happens when that happens is that those individuals flee the country. They will leave the country to see if they can find a better tax situation.
Or their money leaves the country.
The money leaves the country, or they look, and she was very polite. She says, or they look for ways to avoid taxes that are legal. And I will tell you, in working with over 400 small businesses over the last 16 years, or they look for illegal ways to not pay their taxes. And as the taxes get more into line with their expectations and hopes and what they think they can afford, then they are willing to pay them, or they're not willing to go to such risk in terms of illegal and or spending the money that you normally have to spend in order to get the legal methods for avoiding taxes. So this is the LER curve. It's proving out here on the chart.
And it's, it was the theory of Art Laffer. He was an economist, famously. The most, what is the word? The best the finest economist not to have ever won the Nobel Prize.
Because he was associated with conservatives.
Yeah, he was Ronald Reagan's famous advisor, and he's the guy that Bush, the elder, called a voodoo economist.
And he's Cathy Wood's mentor and still is.
Yes, yes, he is. He must be over 80 now.
I think so.
Yeah. So, but this is proof positive. If you look at this curve, it's very interesting. Look how, as the tax came down, GDP rose.
Right.
Isn't it amazing?
Yep.
GDP up, taxes down.
Yep.
And it wasn't such a smooth curve because we had, a pandemic in the meantime. So yeah, so this is indicative of the Laffer curve. The actual, if you look at the black line here, it's the tax rate. If you look at the blue line here, that is the GDP. And what is the green line? That's the tax rate. So the black line is
Tax receipts.
highest tax rate. Highest tax rate.
Oh, highest tax rate. Okay.
Yeah. Yeah, so that's the Laffer curve. And, a lot of what we talk about is driven by the Laffer curve.
Right.
So Cathy divides this into sections, and we're now in the section of monetary policy. And monetary policy is controlled by the Federal Reserve. That's the reserve that either puts money into the economy or takes money out of the economy. And they do it by adjusting the interest rate that they charge banks, and they either allow banks to borrow at lower rates or they jack up their rates and tighten the money supply. And so that puts up the price of money, and that's the Fed funds rate. And so in 2007 and 2008, they peaked. That was the crisis in 2007, 2008. They peaked. And then, after that, they allowed their funds rate to go to functionally zero.
Mm-hmm.
In the last 16 months, though, from 2022 to 2023, we saw the Fed funds rate go through the roof. And that's the change, the actual rate of change of the federal funds rates. It went from zero to over 5% in a matter of a few months. And that drove the rate of change up very dramatically. So the shock from the low rate environment sparked this rolling recession that we're in, shut down house buying, shut down a lot of manufacturing, shut down, a huge portion of the economy, and it hurt particularly, I think, small businesses.
Well, and it was done, Larry, and I wish she had said this because it was done in an environment where we had this boom bust.
Yeah.
And people don't understand the boom bust unless they've been right in the middle of it. I can explain it to people all day long, and they're like, "What are you even talking about?" But you end up moving the inventory of the. We're talking about goods now. You end up moving the goods in a boom. You have goods in short supply, people scrambling to buy the goods, so the prices go up. And I always use the refrigerator as my example because if I use bicycles, everybody laughs at me. So I'll use a refrigerator. So everybody that wants a refrigerator buys a refrigerator during the boom. And the bust comes the next year when everybody that wanted to buy a refrigerator next year already bought it this year. Okay. And so then you have this bust. Well, if you have a bust, that's hurting manufacturing. That's hurting the overall economy. And then if you also raise the interest rates so that the company that is now in a little bit of trouble and needs to borrow money is paying way more money for the capital, they don't borrow.
And the whole boom bust cycle is the reason that Federal Reserve tends to be loath to move the interest rates too high or too low too quickly. But sometimes they're faced with no alternative, particularly when you have a catastrophe like we had in 2008 or a catastrophe like we had in COVID. And in COVID, the problem is they acted and then the federal government acted separately. And so, the Trump administration pumped a lot of money into the economy at the same time as the Federal Reserve was. And that would have been fine. We were actually coming out of it fine. But then Biden, in his dotage, decided to add, double down,
Yep.
triple down,
Yep.
quadruple down, and put a huge amount of money into the economy. And the Federal Reserve just actually had to shut down. So we had, a ship that was being steered by two masters. The other factor in inflation is not just the supply of money, it's the rate at which we spend the money between one another. It's called the velocity of money. So even if the supply of money is gigantic, if we just sit on it, if we don't actually spend it and buy it and buy and sell, there's nothing happened. So the velocity of money is very important, and you will notice how the velocity of money simply plunged during the pandemic, and you'll see how quickly it rose after the pandemic. And now we're thinking that it's on its way back down again. We're hoping.
So Larry, I'm gonna get on one of my I forget the word for it right now. Anyway, I believe that a big reason the velocity of money has slowed down is because of demographics. You have a lot of money changing hands if in the household formation years. You have a lot more purchasing of goods and services during the family formation years. And you especially have that when you're talking about families of 2, 3, 4 kids instead of one kid.
Yep.
Now you have an aging population that does not buy as many goods. They're going to buy more adventure, but they're putting their money into where? They're putting their money into their pension funds, and they're not moving. So we used to move our household every 5 years. Larry, remember those days?
I do.
Buying and selling. They were selling a house and moving on to a new house every 5 years. Now last time I heard, I think it's over 12, and it might be more than that now. So that's the number one purchase anybody ever makes. And if you're making that purchase every 12 years instead of every 5 years, that's going to have a huge impact on how fast money's moving.
I agree. I think that may have a function. I mean, there's another factor, and that's the baby boomers are aging out. They're retiring.
Yes.
And so that could have a real impact on, the number of households being formed. So then we move, from monetary policy to economic indicators. What's actually happening in the real economy? Not what's the theory or what's the Fed doing and what's going to come. But we see the impacts here of a rolling recession. To your point, home sales are down 39% due to high mortgage rates trapping homeowners. There's existing home sales. Kind of this is the norm. You'll see 2008 was a killer for the norm because 2007, 2008 got crazy.
Right.
And it kind of returned back to norm in the times of ZIRP, zero interest rates, when we could buy and sell property with almost no cost in terms of the mortgage. I mean, a 1-2% rate for the mortgage or 2 or 3% rate for the mortgage. And then we had COVID, we had post-COVID, and now look at that.
Yeah. And we have not only the mortgage rates that are trapping people in their homes, you also have what they call die in place.
Yes.
Larry, you and I are both examples. This is my last place I'm going to live.
Yeah.
I've been living in this place now for 9 years. I intend to stay in this place until they carry me out.
We've been here for 14 years, and we've kind of made this place. I mean, we've added on and changed, and we spent a lot of money on the place. But we're really thinking about going to a smaller place. This is a big house. It's not a giant house, but it's a big house for 2 people to rattle around in. The grandkids are growing up. So, this may be the last year or the second last year that they'll come and swim in our pool.
Yeah, right.
And the pool's lovely. I mean, it's a beautiful garden to sit out in the evening, have a glass of wine and all of that. But, it may be it may be we will move. We are thinking about it. So, but you're right. I mean, a lot of that is happening. And then, auto sales is very interesting because we've seen auto sales collapse, then, peak again from that collapse. By the way, this is what is considered to be a good auto year, up in the 16 million range. 15 million is kind of below norms. So 15.5, is where it needs to be, but it doesn't often get there, and there's often drops to very, very small numbers. This is why the auto business is so difficult to be in, and so difficult to manage, and so difficult to make money out of. But we had a very big spike just now because of the impending tariffs. But you'll see that actually, absent that spike, we were down at the 15 million mark, which is not where the auto industry needs to be.
Now, once again, just a quick note, you'll notice that there's no growth. There's no growth in this chart. Okay, we've got the tops being around 16 to 18 million. There's no growth. There's been no growth in my lifetime in business, all the way going back to the 70s. There's no growth in the auto business, even though the population has dramatically grown. So there's obviously a couple of reasons for that. One of those has been over the years that the cars last so much longer. So where we would throw a car away before it was 100,000 miles, you got rid of it. Now you drive them 150, 160,000 miles. They last 20 years. People don't think anything at all about keeping a car for 15 to 20 years. So that has dramatically decreased the number of total cars. But now what we're seeing is the young people are not buying cars.
Yep, correct.
So that's now having an impact. So these are outside of the recession, but then you also have this recession impacting auto sales as well, which is her point, is that one of the four areas that is in a rolling recession.
Manufacturing. So there we are below the line on manufacturing. I mean, so this is a diffusion index. What it means is that below the line is the contraction. Above the line is growth. So once you're below the line, which we are now and have been for some time, with a small blip when the election happened, below 50 is contraction, which is the state since interest rates spiked in 2022. I think manufacturing is going to get a big fillip from from what's happening with the tariffs. I could be wrong, but that could be an engine for future recovery.
And by the way, this is a PMI. So this is a Purchasing Managers Index. This is a survey. This is not measuring actual amounts of money that's going through the manufacturing system, but rather what purchasing managers are predicting is going to happen in their business. And we have seen this drop.
And it's not on their business, it's in their capital spending.
Capital. Is this a capital spending one?
Yeah. Capital goods spending.
On their capital spending. Okay.
Yeah. Oh, sorry, I'm wrong. It's not the capital spending. This is the capital spending. Capital goods orders, non-defense, aircraft and parts. And aircraft, I mean, because of Boeing's problems, they've plunged anyway.
Right. Now, I think this one is actual spending from the GDP. And this is where we saw the nice bump in the first quarter.
This is not spending. This is orders.
Oh.
New orders.
New orders. Okay. New orders. Okay.
So that revenue won't have hit the books yet.
Right.
And then small business optimism. Look how it peaked at the election.
Yes.
Look how it's dropped since the election.
Yes. And it's all about tariffs.
Yes.
Okay. Now I need to get on my hobby horse again, Larry.
Dude, get on your hobby horse.
I did something on that. I wish Cathy had read my X, because I believe she would agree with me. Maybe you will, maybe you won't. The tariff thing is 100% driven by the negative news, because you have the folks, business owners as well as the consumers, thinking that we might be going back to 6 or 7% inflation. There's no way to get there. There's no way to get there with these tariffs. I've asked Grok. I've looked at economists. I've listened to, I've read everything I can read on the subject. Nobody thinks it's going to be above 1.5% at the very most, the impact on pricing in this year due to tariffs. That'd be the worst case scenario is 1.5, according to Grok. My number is 0.8. So this is driven by negative headlines of the press trying to scare the population about the Trump administration. And this is what's they would like nothing better than to see Trump fail. And we know we got 94% negative press on Trump so far. And I think that's what's driving this. Is again, these are surveys about people's opinion about the future, not actual numbers.
Yeah, I actually don't entirely align with you on this. I think that a large number of small businesses will not be able to get their goods in time to maintain revenue. I think there will be a large number of them that are discombobulated by the failure to be able to buy. And you talked about it's only 14% of our imports. That's not a way to look at it. It's not what percentage of your imports it is. It's the business that 14% enables, whether that's a component for a manufactured good or whether it's part of your offering of your product offering. And so it's not just the resale of those 14%. It's the component that 14% represents in your business. And in any case, it's marginal to your business. If you have to lose 14% of your revenue, you're probably going to make a loss. If you're going to make a loss, you're going to have to, conserve cash. If you have to conserve cash, you have to start laying off. So there's a lot more to it than, just simply saying, well, it's only 14% of our goods that we import. So I think there's a lot more to it about optimism versus pessimism, but it's not at a terrible point yet. It's still, relatively, well, it's not really that high, but it was getting to the heights when the election took place. So we'll see.
Yeah, as Cathy said, it'll be interesting to see what they say this month.
Yes.
We'll see that in a couple of weeks.
Yes. So consumer sentiment across income levels collapsed. High-end consumer spending dropped in April. So there it is. I mean, you can say all you want about 14% of our tariffs, but when the consumer stops spending, the pain goes from the top to the bottom, or from the bottom to the top in the economy. And so this is probably pretty darn serious. This is the top third, the bottom third, and the middle third. So, Cathy's thesis that we're at the point of recovery in this rolling recession may or may not be right. My thesis that we're in a recession, not a rolling recession, but an actual recession, and we're going to have 2 quarters of negative growth, I think is the more probable.
Okay, just one caveat, and that is consumer spending at the end of April. We're talking about, I think, through the 26th of April was the last report I saw from MasterCard saying we're still at 6 to 7% increase compared to last year in terms of consumer spending. So
time will tell. Time will tell. Time will tell. So here's consumer expectations and yield curve. So let's look at yield curve, 10-year Treasury yield minus 2-year. And look where we're going. We're going up. So this is a so-called recession predictor. Now, Cathy raises doubt about the recession predictor. She says that in the period of great invention, 1880s to 1920, 1930 really, we had, the yield curve was negative all that period of time. So this notion that the yield curve then produces a recession may be upside down. Maybe we're going to see a long-term negative yield curve. And I can buy that, by the way. Mm-hmm. Not that we didn't have terrible recessions during that period. We had really, major recessions during that period. But anyway, let's move on. So then we get to market indicators. So what is the market telling us? And then Cathy goes into, this is really the central thesis of ARK Invest. The central thesis is that these technologies that are very closely related to one another, like autonomous mobility, advanced battery technology, smart contracts, cryptocurrencies, you know, robotics, humanoid robotics, all of these related technologies, and each principal technology is in a different color, and they all connect to one another. This is the conversion of all the technological development that we've seen, this incredible explosion of technological development, driven principally by AI, by these neural networks that are so magical. At the center of all of this, they're driving a complete change to our economy. And we're going to see this gigantic spurt of growth as we had witnessed in the second industrial revolution. This is a new revolution. It's a technological revolution. It's going to drive gigantic growth. It's going to change forever how the economy works. And we're in the midst of it.
Right.
And we're going to see it emerge in the numbers. And so one of the points she makes very strongly is that, in the years of 1880 to 1930, we saw a consistent, yield curve where the long-term rate was lower
Right.
than the short-term rate.
Yeah, that was actually shocking to me. And I think when she first saw it, I think she was even shocked. That was like 3 months ago. And she's like,
Yeah. It opened her eyes for sure, and she's been on it since then. So consumer expectations and yield curve. So now we get to Trueflation. By the way, I misspelled Trueflation in
oh,
this
well,
slide.
they'll forgive you this once.
Maybe we shouldn't tell them.
So I don't know. I don't know if I've come back to Trueflation or not. I was a big fan. You remember, Larry? I
I
was
do.
reporting on Trueflation, and then they kept on changing their methodology like every
Yep.
month or every 2 months, and it threw off the ability to anticipate. In other words, the information may have been true, but you couldn't predict based on it because they would just change the number.
That's
And
right.
you're like, okay, inflation is going to be at 1.2, and then the next day they're saying inflation is going to be at 2.2, and so there was no way to use it. Maybe they're getting better. Cathy is now looking at them. Maybe I need to go back and pay more attention to them again. But if they're right, we're going to be in good shape on the inflationary front.
Look, as somebody who actually invented a index, I will tell you that it's an awfully difficult thing to do, and it does call for evolution over time, particularly in the early days. I mean, in the early days, it does end up causing, particularly if you go public with it early, as the Trueflation people did.
And
They would have,
especially when you're talking about something this complex.
yeah. They would have been probably better off to have kept it a little bit, quiet for a while. Anyway, so it's definitely pointing downwards. Trueflation is leading CPI down. You'll see that ever since they changed their method here. I remember when it bumped up that one time, we became so disappointed. But actually, as it turned out, the actual rate of inflation has followed it with some significant um, closeness. So I would say that they're probably getting it right, and it looks like our inflation is now below 2%.
And here's again my one little comment on this is that I watch this so carefully, and I talk about it all the time on my show. And I can't find the place where inflation is going to pick up in the future. So you look at the big ones like housing and commodities, and you just go across the list of the major categories, and there's
Yeah.
no real evidence of where inflation is going to pick
Well,
up.
the naysayers say it's going to be in the tariffs.
Well, again, but that's not inflation, that's price. So that would be a one-timer.
But the way one-timers hit the economy and the way they ripple through it does appear to be inflation.
Sometimes can be, but I will say my caveat to myself is the one thing that continues to be high is the labor cost year over year. That's still running at 4%, and that's probably a little too strong.
Yeah, and as long as the federal government, well, they've stopped now, but as long as the local government competes with industry for employment, it's going to keep driving that wage rate.
Yep.
And it's time for the local governments to do a DOJO.
That's right.
Yeah, it really is time.
Starting in California, the fourth largest economy in the world.
Market strategy and headwinds. So here's the market cap of the largest stocks relative to the 75th percentile.
Yeah.
So if there's any, real criticism that can be leveled at the current market and where we are in the current market is this concentration into 7 or 6 or 5 or 8 stocks. I mean, they're just these very few stocks that have all the value in the market, and all these other stocks have none. I've seen study after study after study of the middle market companies where they never go anywhere, and even when they go somewhere, very soon they dissipate their value. And so the market's just not interested in them. It's just not investing in them. I, by the way, have just started investing in these infrastructure companies from that middle market segment.
Yes,
I think I'm going to do well out of it. We'll see.
Yeah.
So the market cap is out of all proportion to what it's ever been. But look back here, in 1932, it nearly reached that level. But that was because there was this massive, massive recession.
Mm-hmm.
The market crashed and only 20 or 30 stocks survived. The market was much smaller then.
Mm-hmm.
So that 20, 30% was a much larger percentage of the market by far than the 7 stocks compared to the many thousands that there are in the market right now. Although the numbers in the market have shrunk generally.
Yeah. Yes, that's true. That's part of the problem.
Well, and so few companies are going public today.
Yes, right.
It's actually more profitable to stay private.
Private, yep.
But Cathy says that innovation-based strategies faced headwinds, rising rates, market concentration, valuations. So everybody criticizes ARK funds for not performing very well. But this is true that right now there are huge headwinds against them. The rates, the concentration into these 7 stocks, and the valuations that these companies are getting. But she thinks the headwinds are now easing, that the rates are falling, market is broadening, and innovation values are low. So she expects a healthier, broader bull market driven by the productivity we've spoken about again and again, and that will help her stocks a huge amount out of all proportion to other stocks. So this may be a very good time to acquire ARK stocks, but I'm not selling for them. I don't
No.
Market strategy and headwinds. And here, Cathy shows just how poorly her stocks have performed, with the exception of the 2023, the COVID era. That was a unusual event, obviously. But innovation-based strategies faced headwinds, rising rates, market concentration, and valuations. So here we are. I think this is a really good time.
Yeah.
Invest in ARKs, in their thesis. So whether you invest with them or somebody else is a different matter. But I think their thesis is right on the money now.
Well, their number one company on most of their funds is Tesla. So there you go.
Tesla, SpaceX in their venture fund. So, I mean, it's a really good time to invest with them. I think, and this is not investment advice, everybody, look at your own considerations. This slide we've shown before, so we don't want to talk about it at length, but it's a slide that you should download from ARK and study it. This is how disruptive innovation could grow to dominate markets. So we now have these 7 dominant companies. We could have 30 dominant companies tomorrow, as we did have rising out of World War II, stretching across the spectrum of these new innovations in these principal technologies that Cathy's talking about. It's be a generational opportunity. A generational opportunity. By the way, that's why my grandchildren's money is invested with ARK.
Yeah. Generational.
Yeah, correct. The bond market.
Yeah. So here we go. This is, another one of my special areas, which I've never bought a bond in my life, but I have been following it, like on a twice a day basis now for 2 years. We are sitting here at the 10-year at 4.3, I believe it was on Friday night. I was so sad to see it go back over 4.25. So you've got Larry, you and I've talked about it 100 times. People can go back and look at last night's show. You've got all these forces, the Japanese selling and not buying, the Chinese selling and not buying. And both of those things obviously are going to impact price. I don't know what's happening with the U.S. buyer, but maybe the U.S. buyers, the regular folks that might be like you or I, who are the big funds who have huge investments in treasuries. Maybe they're buying normally, which is keeping it where it is. But it's a deal right now to get a 10-year at 4.3.
The reason I would say that you should be a little cautious in this market is that they have a heck of a lot of bonds to sell.
Yeah. Yep.
And there isn't a large appetite for them at the moment, particularly overseas. It may be an impact of, cyber money, I mean, you
Right.
can, and the other aspect, and gold, people are fleeing to non-US denominated assets.
Well, they're also right now they're jumping back into equities, which is also going to affect bonds. People are taking their money out of the bonds and putting it into equities.
Yeah, but they're still sitting on huge dollops of cash.
Right.
There are gigantic sums of cash. Listen, I'm 80% cash.
80%.
Yeah. Yeah.
Yeah. You and Warren.
Well, I've been 80% cash for a very long time. Very long time. I mean, the cash dipped quite low, because of the growth of the equities, the extraordinary growth of the equities during SERP. But, I trimmed after COVID. COVID went so high that I just had to. I stick with my winners, but things that, So what happened with COVID is I trimmed my stocks from about 14 stocks to 3 or 4.
Mm-hmm.
I'm only in about 6 stocks now.
Mm.
And all the rest I have in bond funds.
Yeah. Well, again, I'm just going to say, I'll say it again. I've said it several times on bonds. 4.3 in this environment with inflation basically zero for the last 2 months. Core PCE, PCE, core PCE at zero for 2 months in a row. The bonds at 4.3 is a steal.
Well, as long as the Fed have all these bonds to sell, I think people will be stealing them and stealing them at higher rates. So I remain very, very comfortable with where the bond, not where the bonds are, but with sitting with bonds.
Right.
And then we get to the Bloomberg Commodity Index. This is the slide that Cathy always rolls out, and it's a very, very compelling slide because this shows you what commodities cost back in 1980 and what they cost today.
Yep.
And there's just no reinflation.
No.
So, in the 90s, the Fed reacted to long-term capital market, LTCM imploding, Y2K and the dot-com bust, and so they, pumped in money. But since then, other than the COVID shock, which is here, we've not experienced inflation.
Right.
Commodities are remain. Now, it'd be interesting to see what happens to commodities with this tariff business, but I think they may go down in price. And actually, oil is down already quite dramatically. Gold is up at the.
And of course, commodities, part of the reasons that they're down is because of automation,
Yes.
extraction methodologies are better. So, and a lot of commodities, of course, are crops, farm goods, and those have been automated. And I'm sure they're going to be even more automated.
Yep. 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 So this slide intrigues Cathy a great deal. She says that the metals gold ratio, so this is metals to gold ratio versus the 10-year treasury. So in this slide, we have the 10-year treasury is the green. That's the 10-year treasury rate. That's the 4%.
Mm-hmm.
And this blue line is the ratio that metals have to gold.
So basically looking at the commodities index being flat, looking at gold going off the charts, and then looking at the bond yields staying at 4.3, this is really getting worse, not better.
Worser and worser.
Worser.
And it's really hard to imagine. It's hard to imagine that this continues.
Yeah, I can't see it.
But if gold has become the new gold,
yeah,
then it's quite possible that we're in a transition back to gold as a standard. It wouldn't shock me. I think Cathy would say Bitcoin would be part of that mix.
yeah.
I just don't think I don't think there's just it would have to get to the, I don't know, $1 million a coin in that range to become usable as that sort of international standard. So it's very interesting, and I'm surprised at gold. I mean, gold would have to be at about 15,000, maybe 20,000 in that range. But there you are. I mean, that's what the world is saying right now, that, they're changing the game.
I look at that chart, Larry, and I say that your bond funds are going to do really, really, really well.
Yes.
Not investment advice.
Yep. No, I agree. Then we have the S&P price to gold, and it appears to be breaking down. Cathy says that it appears to be breaking down because it was up here, but it's I don't see much correlation across these years.
Yeah.
There's in 1940, there we are now. We're where we were in 1940. That was the middle of a war. No, this was 1930, sorry. That was in the middle of a recession. Then we recovered, let's say 1950, 1960, good years. It was about there, which was way below there. So I'm not aligned yet with Cathy. I'd like to understand this a little bit more.
Yeah.
But she says the next chart, anyway, contradicts this, because this is crude oil showing that, crude oil, collapsed in the 70s, but otherwise it was kind of here and now we're up here. I think the oil price collapsing is stimulative, and that's for sure. And the S&P gold ratio will reverse as the global economy improves. By and large, the world has always come back to the dollar.
Yep.
We had this terrible 70s, came to the dollar. We went off gold and came to the dollar. And since the 70s, we've had several crises, but in the end, we always come back to the dollar. And, if Trump is able to have his way, if he's able to forge a new economy out of this economy, the dollar will bounce back again.
And it hasn't gone that much, Larry. It really hasn't.
No, it hasn't. It's just the dollar as a reserve currency for these reserve banks will bounce back again, which means they'll start buying our bonds again.
Right.
Which is really good for the bond price, for the bond yield. And then Cathy always looks at this slide because it tells us of the health of our companies, the ratio of high yield bond yields to the 10-year treasury yield. So companies that issue high yield bonds, how high are they? How expensive are they? In other words, how much interest do they have to pay compared to what the 10-year, US Treasury yields. And right now it's low by historic standards. It's starting to go up a little, not much, not much. Major spikes occur in a recession, so this will have to be watched closely. So this is counterindicative to my thesis.
Yes, and it also, Cathy gets it a little bit wrong when she talked about the small business owners. The small business owners are not concerned about borrowing. They're able to borrow at good rates. They say this every month. I point this out every month when I do the small business report, and this is evidence that the middle range companies also, the larger corporations, are not borrowing. They're not having trouble borrowing either.
I think we should invite Cathy on because we both have sufficient areas where we have questions to ask her where perhaps she can convince us we're wrong. So
That'd
it would be
incredible. That'd be incredible. Love them. Yeah.
And then Bitcoin to gold ratio. Well, this is a very interesting slide because I hadn't seen, I hadn't paid attention. I've seen the slide before, but I haven't paid attention to the slide. They present it quite often at the brainstorm, but here in this slide, there's very strong trend line, very strong. And even though we're actually falling off trend line, it looks to me like, even though gold went parabolic, it didn't break the uptrend. There's still this constant trend of Bitcoin constantly rising against gold. Very strong.
Right.
And ARK believes that it's going to continue, and it's going to continue upwards like the NASDAQ.
Yep. I don't know.
So we can wrap up. We're already about 20 minutes over our normal time, but we can wrap up and say the market's poised to overcome headwinds with upside potential. Cathy says, I have my doubts. You're very strong. You may even be stronger than Cathy on this.
I think I am, yes.
And Cathy says a productivity-driven recovery is expected to end the rolling recession. I think we've got more pain to go through. However, I'm very aligned with Cathy that the next recovery is going to be incredible. The economy is going to go gangbusters out of us, and it's going to be led by the very things Cathy talked about.
So I guess the optimistic conclusion would be Randy says we go through no more pain, really, no serious pain over the next 3 to 6 months. There'll be companies that'll go bankrupt. There's always companies that go bankrupt. It's no big surprise. They talk about
it's not one of ours. That's fine.
Yes, it's like one of ours. And so we could have 3 to 6 months of some difficulties and some challenges. I think it'll stay above the line. You think it might go below the line. Many people agree with you, Larry. Many agree with me. But that probably third or fourth quarter, we begin the golden age.
I think we're going to have a very, very, very tough fourth quarter.
Fourth quarter. Wow.
Yeah.
Okay. I think
I think the first quarter next year could be gangbusters. Okay. And by the way, that's the pattern that Trump set in his first term.
Yeah. So,
and in summary, I've criticized some of the actions that Trump has taken, but I can't tell you how pleased I am with the law, with his policies in general, and with the cabinet picks and the cabinet performance to date. I can't tell you.
Excellent. Yep, 100%. Yeah, no, it's a very fun time for those of us who have, I guess you would call them conservative leanings economically. Everything seems to be on the right directionally on the right path, and all we have to do is solve the tariffs in China. And I don't see anything to keep us from going parabolic.
Look, I'm a conservative,
astronomic. I don't know, something like that.
I'm a conservative economically and fairly liberal socially, but my liberal socialism is very, very different to liberal socialism. To the liberal
of today, yes,
of this day, yeah.
Absolutely. I know this about you, Larry. Hey, Larry, it was great as always going through the Cathy Wood stuff. Appreciate you, all the work you do. Everybody should give you a hand right now for the great slideshow.
Well, Grok kind of did it, you know.
Yeah, you said. Yeah.
I actually had to do some of the finishing stuff, but Grok was pretty good at it this time.
Nice, nice. That's great. I have to start I use Grok every day now, but I'm seeing more opportunities having seen this slideshow. So, any last thoughts, Larry?
No, it's just real fun to listen to Cathy each month, I guess, and get a deeper insight each time. So,
All right. Well, Larry, again, thank you, and to all of you out there, it's been great talking to you.